Hello, Maker Evers students. We are going to talk about legal form of organizing one's business and writing a written founder's agreement. So after you decide to start a business, then hopefully we hope that you are going to select a legal form to organize your business in versus just operating in the unregistered or informal economy. Now, if you decide, there are a couple of questions. Number one, do I really need to register my business? Should I? Can I just start selling? Should I make my business a corporation? Are there other forms I should choose in addition to a corporation? And what other questions should I begin asking? Well, to answer those questions, some of the issues that you really want to start looking at is number one, how much control do you, as a co-founding owner of this business, how much do you want to maintain? How much control? 100%? Are you willing to relinquish some of that control in exchange for expertise, in exchange for finances, in exchange for other resources? So that's the first issue. The second one is, are you willing to pay a lot of money on the front end in terms of legal support for setting up documentation, for filing paperwork, yearly, quarterly, annually, and or do you just want to keep it simple, do the minimum as possible? Whichever your choice, then that has implications on which legal form you choose. Also, your personal liability. So if I own a company and if my company does something really bad and someone sues and the court says, okay, Micah, you and your company, you owe this person this amount of money. And then depending on which choice I made, if my company is worth $100,000 and the court say the person is entitled to $1 million, depending on which choice I made, I may pay $100,000 and then we're done, or I still may owe the rest of the $1 million. Okay, how you want to be taxed on the money that your business creates. So businesses, they make revenue and they make profit. So when someone says I made $100,000 last month for my business, then you have to ask, are you talking about $100,000 in revenue or are you talking about $100,000 of profit? And so if we're talking about profit, how much of that money Uncle Sam gets for tax matters based on what choice you make. And then the other one is whether you want to raise money for your business. Sometimes a business owner just wants to keep that business as a mom and pop shop. Sometimes they only want to open up 1 or 2 locations and they don't need external financing. But other times, business owners want to scale their businesses. They want to really blitz a market. They want to replicate and really, really grow their business rapidly. And almost always doing so requires external funding. So these are some of the issues. There are more, for example, unlimited life. Um, when you decide to retire, does your business retire automatically because you retire, or does your business live on? When you reach that nice age of 110, 115, and you decide that you're going to leave this earth, does the business leave the earth with you, or does the business live on? Which choice you make matters. So here are the choices right here. These are the 4 broad choices, and 2 of these choices have sub-choices within them. Sole proprietorship means that the person and the business are one. The business really is an action. It's a verb. It's something the owner does. It's a sole proprietorship. They're one. If my business does something bad and I'm a sole proprietor, that means I did something bad and I'm liable. I'm responsible. Setting up as a corporation or a limited liability company, the business is a separate entity other than the person. So, and some forms of partnerships are like that. But right here, the business is a separate entity. So Micah is one person and the corporation that he may own is a second person. Corporations are acknowledged as persons. They can be sued. They can sue in court. They can do a lot of different things that humans can do. And so I can be a good guy and my corporation can be a bad person and my corporation does something bad and then therefore, it just has to go away. But even though my personal assets may be worth a lot more than a corporation, whoever sues, they only get the assets of the corporation. They cannot come after my personal assets because a corporation affords me limited liability protection. And the liability only exceeds the value of the corporation. Okay, so C Corp, that's the big one where thousands of people can own it. An S Corp is a smaller version that provides a benefit. Let me explain the benefit. C Corps, the money, the revenues, the profit that is made from a C Corp is double taxed. So if a C Corp makes $100,000 a year profit, Uncle Sam takes his cut right off the top. And so if Uncle Sam says, give me 20% of that, and the business made $100,000 profit, then Uncle Sam takes 20%. And then the owners are like, ooh, we get the 80%, let's divide it up amongst ourselves, and then we get to spend all of it. Uncle Sam said, no, each of y'all have to give me a tax on your percentage. They're like, what? We already paid tax when it was $100,000. Uncle Sam's like, whatever, you're in a C Corp. You get double tax. You know the rules. Come on, pony up. And so, therefore, C Corps, they have double taxation. However, S Corps don't have that. But S Corps, they can only have up to 100 members, owners, and one married couple can be counted as one particular member or owner. And also, all of the owners have to be U.S. citizens. So there's some stipulations over there. A B Corp is set up mainly because C Corps, the managers of a C Corporation, their primary duty is to shareholders. Their primary duty is to make decisions that are in the best financial interest of the people who own the company. However, B corporations, they're like, no, we want to look out for society. We want to look out for the planet. We want to look out for other shareholders other than just other stakeholders other than just the owners of the company. And so therefore, B corporation managers have protection to be able to make decisions that may not be in the maximum interest of shareholders, but instead that help society and other stakeholders. Okay, so limited liability companies. Those are really, really nice. Limited liability companies, they don't have double taxation. They also don't have unlimited liability. And it's a really nice hybrid that works really good for many of you. Others of you, B Corp is going to be good, and some of your S Corp is going to be good. Okay, so over here, I don't want to go into this because of time. I'd like for you all to come in office hours and ask me questions about this if you want. We can talk about that. We can talk amongst ourselves. But so I just put some frowny faces in some of these. So, for example, C Corp, when it comes to double taxation, not good. Sole proprietorship, when it comes to personal liability, not good. Sole proprietorship, when it comes to trying to raise money externally, not good. And so there are a whole bunch of other things. And so I want you to look at that, pause this, and then write down some questions or Google them or talk to other people in the class, and then we can find out about all of that. Over here, some really helpful links. If you want to register your business and select a legal form, you can click on this link right here, and you can find out how to do that. It costs you less than $300 to do that in New York. If you choose to do an LLC, you can click on that link right there and find out. Here's additional information for New York State. And then also getting an employee identification number. You'll need that if you're going to go formal. That's very important to go ahead and get that. And then also the name. Number one, you come up with a really, really good name. First thing you got to find out is if somebody beat you to that name already. Second thing you want to do is register that name, own it, make that name yours. Cost you $25 to do that, and you can click on that site right there. Depending on your business, for example, if you're a restaurant and I'm a cleaners and somebody else is a transportation business, then we fall under different rules and different restrictions, so you have to find out. But all of us who are selling and collecting sales, we need to have the authority to do that. So click on that and to figure out how to get that. Different types of taxes that businesses pay. So if I sell a soda for $1, I'm supposed to pay Uncle Sam. I'm supposed to collect taxes on that soda and then give that to Uncle Sam. Um, Also, employee payroll taxes. Uncle Sam, I'm supposed to pay part of that. And then also the amount of profit that the business generates, I have to pay Uncle Sam a portion of that. So those are taxes that businesses have to pay. Try to avoid these and staying informal pigeonholes a business owner, and it pigeonholes a business. It actually keeps that business performing much lower than if the business were to go legal, open itself up, expose itself. So businesses that do this, they actually position themselves to be a lot more successful economically. The other thing is, many of you want to check in for obtaining these designations right here: minority and or women business owned business enterprises, minority and women owned business enterprises. So we call them WMBEs. And a lot of you all want to get that designation. Now, it is controversial. Many people will argue like you shouldn't do it. Once you do it, you pigeonhole yourself. You shouldn't do it. So there are two sides to that argument. You want to familiarize yourself with them. But I think that in New York, many of you should, I believe, my personal opinion is that you should get it. There's lots of set aside money. We have the School of Business. We have friends who are in the industry who divvy out $20 million a year, and they're always looking for and can't find people who fit this category and who are qualified. And so that money just kind of goes away. There are millions of dollars in the city that goes away each year, and I think it's around $2 billion in New York State that goes untouched because people are not qualified to receive it. Okay, so also Carver Bank. Dean Rowe is very good friends with some of the people there, and they provide a lot of financial assistance, a lot of time assistance to school of business students, and so they're a really good friend. And they came on campus a few months ago, and they would love to help you and your business to open up a bank account. You cannot get the designation unless you have a track record and you have an established bank account. So you definitely want to do that as well. Now, written founders agreement. All right, so that's it on the legal form of business. If you have any questions on that, come on office hours, we'll talk about that. Written founders agreement. These are some of the issues right here. Relative split of equity among founders. So, do you retain 90% and you're only giving up 10%, and all of the other four founders have to figure out how to divide the 10% up? Or you're doing 20-20-20, or you keeping 51, whatever it is. So that's one. How will founders be compensated for any cash they put up in the firm? So you have four founders, three of you all bring $10,000 to the table. Another one only brings up sweat equity. Sweat equity means the labor, the value of his work that he's putting up. Is that sweat equity from that fourth founder? How's that going to be treated? How will the $10,000 cash that each put up, how would that be treated? Those are issues that you want to discuss. How long do founders need to remain with the firm in order for their shares to fully vest? Buyback clause. If one of those founders decides that he, is going to get married and off and he's going to travel the world on a yacht, and then he comes to y'all and say, hey, now that the business is worth $2 million, he says, well, I'm 1/4 owner, so I want my cut right now. Write me a check for it today. And I'll be like, what are you talking about? And then y'all can't give him the check. So next thing you know, he comes back with somebody, he finds somebody like a Jared Kushner. And he says, Jared, why don't you give me, $500,000 and you can have the ownership in my company. Jared says, fine, gives him $500K. Then he comes back to like, hey guys, this is your new owner. And you're like, excuse me? Like, whoa. First of all, we have a buyback clause. You can't do that. All right, some other issues over here is how does the equity split change among you all? Voting rights, names and areas of responsibility. So you can just check those over here. And then I have like 30 seconds, so I want to show y'all something real quick. This is just an example. This is an example of some of the stuff. And you can pause this and look at it. And you can figure all of that out. And that's it. And I think my time is about up. So I just wanted to share that with you all.